In cross-border trade, buyers and sellers occupy a permanent standoff. Importers want goods before paying, while exporters refuse to ship until they see the money. To bridge this gap, banks introduced the letter of credit. It is a conditional guarantee that substitutes the bank's credit for the buyer's credit. This mechanism effectively severs the financial settlement from the physical movement of cargo. This decoupling is governed by the UCP 600, a universally accepted set of rules drafted by the International Chamber of Commerce. Under these rules, banks are explicitly forbidden from dealing with the physical goods. They do not visit warehouses or inspect shipping containers to verify contents. Banks instead assess risk and trigger multi-million-dollar payments based exclusively on the quality of the paperwork presented to them. The result is a parallel documentary reality. Under the UCP 600, this paperwork carries more legal weight than the physical state of the underlying cargo. We can model this risk by looking at an unsecured trade. Here, the exporter, the beneficiary, is exposed to the direct credit risk of the buyer, the applicant. If the buyer defaults, the exporter has zero protection. When the buyer opens a letter of credit, they bring in an issuing bank. This institution puts its own balance sheet between the two parties, promising to pay the exporter on the buyer's behalf. The exporter then brings in their own advising bank to authenticate the credit, completing a circuit of trusted intermediaries that bypasses the need for the buyer and seller to trust each other. This independence is codified in UCP 600 Article 4. It states that the credit is a separate transaction from the sales contract on which it may be based. Article 5 reinforces this by noting that banks deal in documents, not in the goods or services those documents represent. Together, these articles form the principle of autonomy. The bank's obligation to pay exists entirely on its own, regardless of whether the buyer and seller are in a dispute over the cargo. This reliance on paper to represent physical value has been the standard for centuries. On this 1794 Bill of Lading, the handwritten tallies and delivery terms were the only proof the bank needed to honor the trade. This strict autonomy is what allows trade to scale. It provides a standardized logic for settling transactions between entities with no prior relationship. Letters of credit are not static instruments. They are modular tools designed to shift specific types of risk. This matrix categorizes the four primary configurations. The irrevocable LC is the baseline standard for the UCP 600. Once issued, an irrevocable LC cannot be modified or canceled unless the buyer, the seller, and the bank all agree in writing. This locks the payment terms in place. If the exporter is worried about the stability of the buyer's country, they will request a confirmed LC. This adds a second bank, usually in the exporter's country, to the circuit. This second bank absorbs the sovereign risk, guaranteeing payment even if the buyer's bank or country faces a crisis. For trading companies acting as middlemen, the transferable LC provides a different kind of utility. It allows the middleman to transfer portions of the credit to their own suppliers. They can pay the factory using the ultimate buyer's credit, often without revealing the buyer's identity to the manufacturer. These three are documentary LCs, intended for active payment. But a standby letter of credit, or SBLC, serves a secondary purpose. An SBLC is a fallback mechanism. It acts as a performance guarantee and is only triggered if one party fails to meet contractual obligations.
Choosing between these typologies is essentially an algorithmic decision, a way to calculate which bank should absorb the impact of a counterparty or sovereign failure. From the first handshake to the final payment, every transaction follows a rigid 7-step sequence. It begins in Step 1 with the sales contract, followed by Step 2, where the importer applies for the credit at their bank. Step 3 is the formal issuance. The bank sends the credit via the SWIFT network using a highly specific message format, the MT700. This MT700 functions like the operating system for the trade. Field 40A defines the type of credit, while Field 46A lists every document required for payment. One missing document in this field can stall a $1 million transaction. Once the exporter verifies the MT700, they move to Step 4, shipping the goods. In Step 5, the exporter presents the documents stipulated in the LC to their bank for verification. Step 6 is the audit phase. The bank examines the paperwork against the LC terms and releases the payment. Finally, in Step 7, the issuing bank gives the documents to the importer, which allows them to claim the cargo from the carrier. The MT-700 is the code that compiles and executes this physical workflow. It ensures that every movement of freight is mirrored by a movement of data. Step 6, the bank's document examination, is the most common point of failure for the entire system. Industry data reveals that over 65% of all document presentations are rejected on the first attempt due to discrepancies. This audit process is strictly governed by UCP 600 Article 14. Under Article 14, banks have a maximum of 5 banking days following the day of presentation to determine if the documents are compliant. They examine the papers on their face to ensure they align with the LC. Exporters often struggle with these strict compliance standards, assuming that a single typo will automatically lead to a rejection. However, UCP 600 doesn't require the data to be identical. It only requires that the data be non-conflicting. If a packing list describes the goods slightly differently than the invoice, the bank can still honor the payment, as long as the descriptions don't contradict each other. If a bank does find a genuine discrepancy, Article 16 dictates the exact procedure for refusal. This article contains a use it or lose it rule. If the bank fails to notify the presenter of the discrepancies within that 5-day window, they lose their right to refuse. They are legally obligated to pay the exporter, even if the documents were imperfect. These rules are designed to force precision. They ensure that by the time the MT-700 is issued, both parties are operating under a single, unbreakable set of instructions. Scaling out from these individual rules reveals the underlying structure of the global trade network. The letter of credit functions as a rigid, procedural algorithm, a system designed to manufacture trust between entities with no prior relationship. It achieves frictionless commerce by substituting the risk of a single buyer with the established credit of a bank, and replacing the physical uncertainty of cargo with a strictly audited documentary reality. Maintaining this system requires absolute operational discipline, synchronizing the sales contract, the digital fields of the MT-700, and the UCP 600 standards. Mastering this architecture is what allows institutions to move millions of dollars in capital across borders with total confidence, without ever needing to inspect the contents of a shipping container.